Welcome back to Auto News Talk. When we look at the auto industry, we are usually looking for trends.
Right, little arrows pointing up or down.
Exactly. But looking at the stack of research and reports on the desk for this deep dive trend just feels like the wrong word. It feels way too gentle.
I mean, it implies a slope. What we are looking at right here feels more like a cliff, or at least a very sudden, sharp turn.
Yeah, if I had to pick one word to define the current moment in the industry based on these sources, it is recalibration. And I don't mean a mechanic tweaking a fuel mix.
No, definitely not.
I am talking about a hard brake, a check in the rearview mirror, and a sudden lane change across 3 lanes of traffic. We are seeing massive financial write-offs. At the very top, a complete physical transformation of what a dealership lot actually looks like, and a legal landscape that seems to change its mind every time a judge bangs a gavel.
It really is a moment where the industry is aggressively correcting course. For a long time, the roadmap seemed incredibly straight right. Go electric, build huge experience centers, and stay the course.
Right, just follow the line.
But now we're seeing legacy giants hitting the brakes on their original EV plans, while simultaneously new challengers, mostly from China, are finding their way into showrooms and use lots much faster than anyone anticipated.
It is a moment where flexibility isn't just a corporate buzzword. It feels like the only survival strategy. Whether you are a global CEO looking at a balance sheet or a single-point dealer trying to figure out tax compliance, the ground is moving. So let's take a guided tour through this new terrain.
It is fascinating because on one side you have the establishment trying to stop the bleeding, and on the other you have opportunists rushing in to fill the gaps.
Let's start with the biggest headline, the one that really sets the scale of this recalibration. We have to talk about Stellantis. The numbers coming out of their financial reporting are, well, they are staggering.
They are. We are looking at a reported write-off of 22.2 billion euros.
Wow.
That is roughly 26.2 billion US dollars. To put that in perspective, that is not a rounding error or a bad quarter. That is a fundamental reset of their asset values. That is the GDP of a small country.
Okay, let's unpack this because 22 billion euros is a number so big it almost loses meaning. What exactly are they writing off? Is this just bad inventory sitting in a lot somewhere?
No, it is much deeper than that. This is what accountants call impairment. According to the financial breakdown provided in the report on the write-off, the bulk of that amount, about 14.7 billion euros, is tied to canceled products, platform impairments, and reduced profitability for ongoing EV projects.
So they're effectively admitting that the previous plan, the aggressive EV rollout they promised shareholders, simply wasn't going to work financially.
Exactly. They are scrubbing the launch pad.
That is a massive admission of defeat on the old strategy. But there was one detail in that report that I think illustrates this pivot better than the billions. It is the specific transaction involving a battery plant.
You are talking about the Nexstar Energy joint venture.
Yes. I had to read this 3 times to make sure I wasn't hallucinating. As part of this pivot, they exited the Nexstar Energy battery joint venture. They sold their 49% stake to their partner LG Energy Solution. Do you want to tell the listeners the price tag on that sale?
$100.
$100
Yeah.
for a stake in a massive battery plant project.
Yes, a single crisp bill. Now, the report notes that Stellantis cites undisclosed favorable terms that help secure future battery capacity, so there is more to the deal than just the cash. They aren't losing access to the batteries themselves. But on the books, it is a $100 transaction.
But why? Why give ownership of something so critical for basically zero cash?
Because cash preservation is more important than asset ownership right now. It illustrates the severity of the pivot. They need it out of the capital commitment. Building a gigafactory costs billions. By selling for $100, they're essentially saying, we don't want to pay to build this anymore. We just want to buy the cells when you are done.
Right. They needed to stop the bleeding more than they needed the equity.
Exactly.
That is a vivid example of cutting your losses. So if they aren't going all in on owning the EV supply chain anymore, what is the new play? What does the report say is the actual strategy moving forward?
The strategy is now being called freedom of choice, which is a very marketing-friendly way of saying we are going to build what sells.
Makes sense.
Instead of forcing a pure EV timeline, they are balancing internal combustion engines, hybrids, and electric powertrains. The report specifically mentions the cancellation of the battery electric Ram 1500 pickup.
That is a huge deal. The electric Ram was supposed to be a flagship. It was the truck that was going to prove you could do heavy duty and electric at the same time. Canceling it says they didn't think it could reach profitable scale.
Exactly. And honestly, the data backs them up on this. Interestingly, the report highlights that growth shipments rose 43% year over year in the fourth quarter, and that was driven by things like the Ram 1500 with a Hemi V8.
So the market is voting for gas and hybrids.
Right, and Stellantis is realigning their billions to match that vote.
It is a return to realism. So we have the OEMs drastically changing their production maps. But let's zoom into the dealership level. Because if the cars being built are changing, the places selling them are changing too. I was reading through the Saville's outlook regarding the UK dealer property market, and the traditional Glass Palace dealership seems to be under attack.
Under attack might be strong, but it is certainly being reimagined. The Saville's outlook highlights a massive shift toward modular multi-franchise formats. The days of building a bespoke, heavy infrastructure for a single brand, those giant marble temples we were used to, those are fading.
The report mentions that the new Chinese marquis are a big driver of this. They're entering the market, but they aren't playing by the old rules. They aren't demanding dealers build a Taj Mahal.
Right. They need speed to market. They can't wait 2 years for a permit and construction. Savills uses the Chinese brand AION as a specific example. AION has developed a drop-in display system.
I love that concept, the drop-in system. It sounds like something from IKEA.
It is smart, though. It fits into existing footprints. So if you are a dealer with a little extra floor space, you don't have to tear down walls or commit to a 6-month construction project. You literally drop the module in flooring lights branding, and suddenly you are an AION dealer.
That is incredible.
It allows dealers to add the brand without the heavy capital outlay.
It sounds like plug and play for real estate. But does this mean dealers are just becoming landlords for these modules?
In a way, and this connects to a broader trend in ownership that Savills points out. They noted that 90% of the sellers of dealership property over the last 3 years have been institutions.
Institutions? You mean like pension funds and big investment firms?
Exactly, the smart money. For decades, they loved car dealerships, long leases, stable tenants. But now 90% of the sales are institutions getting out. They are fleeing the sector.
That is a telling stat. If the institutions are selling, who is buying?
Operators. Private investors and dealer groups who want to own their own dirt. They want the control to reconfigure the building, maybe add one of those drop-in modules we just mentioned. The Savills report suggests that owner-occupation gives retailers the speed to adapt that institutions just don't have. If you own the building, you can pivot. If you lease it from a pension fund, you are stuck.
So the buildings are becoming more flexible, filled with modular displays. But what about the actual metal on the lot? We talked about the new Chinese brands entering the showrooms with these modules, but there's another invasion happening, and it is happening on the used car lot.
This is where the rubber meets the road, literally. We have data from the Startline used car tracker that reveals something quite surprising. They found that 45% of UK used dealers have already added Chinese brand cars to their stock.
45%. That is nearly half. That feels incredibly fast for brands that, frankly, a lot of consumers might not even recognize yet.
It is fast. But the motivation is pure economics. The survey data shows that among dealers stocking them, 45% report these cars sell quickly, and 33% cite good value as the primary driver.
It is the sales velocity, right? In a market where margins are tight and interest rates are high, you don't care about the badge on the hood as much as you care about how fast it leaves the lot.
Exactly. It creates this fascinating tension. We just discussed Stellantis writing off billions because their EV strategy was too expensive. Meanwhile, you have Chinese brands filtering into the used market and moving fast because they are perceived as high value. It is a completely different value proposition.
But hold on, is not all smooth sailing in it? I imagine there is some risk in stocking a car brand that might not have a dealership in the next town. Did the Startline survey show any pushback?
Oh, absolutely. This is the recalibration for the dealer balancing risk and reward. While the sales velocity is attractive, there is a lot of hesitation. The data shows 37% of dealers are waiting on reliability proof. They are nervous.
Yeah, that makes sense.
And 14% specifically cited anxiety about parts and support.
Right. Because you might sell the car, but if it comes back in 3 weeks with a broken module and you can't get the part because the supply chain is shaky, you have a massive problem.
Precisely. It is a gamble. Dealers are balancing the immediate profit of a quick sale against the potential long-term friction of supporting a brand with no track record. But the fact that nearly half are taking that bet shows how hungry the market is for affordable inventory. They are willing to take the risk to get the metal.
So we have got the OEMs pivoting strategies, the showrooms becoming modular, and the used lots filling up with new entrants. But let's talk about the unsexy stuff that keeps the lights on. The back office. The operators are dealing with a legal and tax landscape that is, well, wobbly is the word that comes to mind.
Wobbly is putting it gently. There have been some major developments regarding tariffs and taxes that dealers need to pay attention to.
Let's start with the tariffs. There was a Supreme Court ruling mentioned in our sources regarding those Trump-era tariffs. What does that mean for the person ordering parts?
It is a classic good news, bad news situation. The Supreme Court effectively ruled that many of those tariffs were illegal. They said the executive branch overstepped. However, and this is a big however, the ruling did not specify how refunds would work.
Ah, the devil is in the details,
Mm-hmm.
or the lack of them. So the court said you shouldn't have paid this, but didn't say here is your check.
Exactly. So dealers and suppliers are left in limbo. They paid these duties. The court says that was illegal, but there is no mechanism yet to get the money back. The sources emphasize that dealers need to isolate duty charges in their accounting. You need to keep clean, retrievable records. Because if a refund process opens up, you need to be ready to prove what you paid.
But there was some immediate relief reported regarding a different tax rate. I saw a report from Automotive News about a new 15% global duty.
Yes, that is the silver lining here. According to that report, vehicles and parts were exempted from this new 15% global duty.
Okay, so that is a bullet dodged.
For now. But the operational headache is still there. The report notes that even with exemptions, the supply chain is wobbling. Automakers are resequencing shipments. That means we could see shortages of high-demand models in some regions just because the logistics flow is being rerouted to avoid potential tax hot zones.
So even if you don't pay the tax, you might not get the truck because the logistics network is scared of the tax.
Correct. Uncertainty costs money, even if the tax doesn't. And then just to pile on the paperwork there is the IRS.
Oh, always the IRS.
Yeah.
What are they up to now?
There is new guidance regarding negative equity. This is huge for the finance and insurance office. When a customer trades in a car and owes more than it is worth, how you handle that shortfall, what is deductible and what is capitalized, is getting stricter scrutiny.
That is critical because, let's be honest, negative equity is very common right now. People bought at the peak and prices have dropped.
It is, and the advice from the sources is clear. You have to verify your deal jackets. Make sure you are breaking out the trade value versus the payoff perfectly. The sources warn against changing sticker prices prematurely based on tariff headlines, but they are adamant about getting your internal record spotless.
It sounds like the era of close enough accounting is over. You need to be precise.
Absolutely. Whether it is tracking a potential tariff refund or justifying a negative equity deduction, the burden of proof is entirely on the dealer.
So let's try to pull all these threads together. We started with Stellantis writing off 22 billion euros. We talked about drop-in showrooms, Chinese used cars, and Supreme Court rulings. What does this all mean when we zoom out?
If we look for the patterns across all these sources, I see three major themes emerging.
Hit me with the first one.
Theme one is financial realism. Look at Stellantis. They took a massive hit to get real about what sells. They stopped chasing a projection and started chasing the customer. Then look at the used car dealers in the Startline survey. They are stocking Chinese brands not because they love them, but because they represent good value and cash flow. The entire market is prioritizing immediate economics over idealistic projections.
That is a great point. It is about cash now, not dreams later. What is the second theme?
Flexibility. The Savills report nailed this. The modular showroom isn't just a design trend, it is a business model. You can't be stuck with a static building anymore. And honestly, the supply chain issues with the tariffs reinforce this too. You have to be ready to pivot your inventory based on what logistics allow. The static dealership model is dead.
And the third?
The friction of transition. There is a real tension here. You have the old guard like Stellantis canceling EVs and retreating to what they know works. Then you have the new entrants, the Chinese brands expanding into UK property and used lots. One is pulling back, the other is pushing in, and the dealer is stuck right in the middle trying to figure out which wagon to hitch their horse to.
It raises a big so what for the listener. If you are running a dealership group or even just managing a department, you can't just set a plan in January and check it in December.
No. Success requires watching the mix. You have to constantly adjust the mix of your inventory, maybe adding those Chinese cars to the used lot. You have to adjust the mix of brands on your floor, maybe using those modular displays. And you have to watch the mix of your tax liabilities. The era of set it and forget it business planning is completely over.
It really is a time for active management. You have to be hands-on.
And you have to be willing to experiment. That is the key takeaway for me. Everyone is experimenting. Stellantis is experimenting with a new freedom of choice lineup. Landlords are experimenting with short leases and modules. Dealers are experimenting with new brands. If you aren't testing something new, you are probably falling behind.
That is a powerful thought to end on. We are in the great laboratory of the auto industry right now.
We are. And the results of these experiments, whether it is the $100 battery plant sale or the drop-in showroom, are going to define the next decade.
Well, that brings us to the end of this segment of Auto News Talk.
It has been a dense one, but necessary.
Absolutely. From billion-dollar write-offs to the nuts and bolts of tariff compliance, the message is clear, and where rescuery is going to be fun.
My final advice is to watch your invoice line items for duty charges. Seriously. And keep a very close eye on how those Chinese brand residuals hold up in the used market. That data is going to tell us a lot about the future.
Great advice. Keep your eyes open, keep your records clean, and we will catch you on the next deep dive. Thanks for listening to Auto News Talk.
Drive safe.